chat is enabled or yeah, okay. You should be able to use the chat section as well now. Yeah. So thank you so much all to all the farmers who dialed in today. We'll just get started. I have a quick intro about NSR Cell. I know many of you might already know NSR Cell, but for those of you who don't, hi, I'm Samhita from the marketing team at NSR Cell, and just I'll take a minute to talk to you about what we do here at NSR Cell. We're the startup incubator of IIM Bangalore, and we've been around for about 25 years now. Um, and we essentially run programs to help entrepreneurs, and these programs are entirely free of cost. We run about 14 different programs in a calendar year, right from idea stage incubation to growth stage incubation. So you can check out our website for any programs that might be of interest to you. Right now, we have applications open for a fintech program. Under a fintech center of excellence that we are doing in partnership with the government of Karnataka. And we also have a program that is open, that's called Impact Orbit, and the non-profits vertical, where we essentially incubate social impact startups that are non-profits. Applications for that program are also currently open. So yeah, that's all about the programs at NSR Cell. If you just want to stay connected to NSR Cell, for any future program, application cycles, any sessions we're doing, any events we're doing, you want to be a part of them, you can either scan this or you can use the link below the QR code to stay in touch with NSR Cell. It leads to all of our social media channels, as well as a WhatsApp channel specifically meant for non-incubators, wherein we put all the sessions we're doing, any call for applications, any partner events, things like that. So you can always just, keep an eye out for what's happening in the startup ecosystem. So that's just, like I promised, less than a minute about NSR Cell. And now on to the session for today. We have Vikrant Potnis, the founder of FundEnable, joining us for a session on unit economics in action. Vikrant, thank you so much for taking the time out to do this session for our founders. Without further ado, over to you.
Thank you so much. Always a pleasure. Thanks a lot for inviting me. Can you just allow me to share my screen, please? Perfect. Great. So good afternoon, everyone, and thank you for joining on a Monday afternoon on this very, very important topic of understanding unit economics. But before that, a very quick background about myself. My name is Vikrant. I run a company called FundEnable. What we do at FundEnable is we invest in startups and we raise multiple rounds of funding for our ventures. So in my limited understanding of running a startup, there are 4 core pillars of running a venture. There is product, there is go-to-market, there is team, and there is capital. So what we do at FundEnable is we take care of the 4th pillar, which is capital, where we will sign a small check, participate in the seed, pre-seed stage, and then ensure that our companies are able to raise multiple rounds of funding going forward. Prior to starting FundEnable, I used to be a part of another company called Origa Asset Leasing, and I exited that business in 2018. And FundEnable is my second venture. And before that, I used to be a part of JP Morgan's India investment banking team and also a part of a fund called Springboard Ventures. So far, I've trained over 2,000 founders in capital raising. And I also run a program called Angel School with Venture Catalyst, where I train investors who want to start angel investing. From an educational background standpoint, I have done my engineering and then I've done a specialization from Cornell in entrepreneurship and entrepreneurial finance. I teach across business schools. Some of the schools that I teach at EDII, XLRIS, Exceed, SPJMR, NSR Cell. I've been taking a lot of sessions over the years. And I also run a show called Startup Nation on CNBC, which runs every day at 7 p.m. These are some of my companies. One of the companies is a company called eMotorAd. eMotorAd is a Pune-based electric cycle company, which basically started operations 3.5 years ago. That is when I started investing, around 1 crore rupees in this business. The seed round. And then we were able to raise $4 million for this company from a US-based climate impact fund called Green Frontier Capital. And Just after that, we raised around 160 crores from a fund called Panthera. This was Series B funding. So we invested, then Green Frontier came in, then Panthera came in. And just before last year's IPL, MS Dhoni invested in this company, and MS Dhoni is also the brand ambassador of the company. So last year, before the IPL, we came up with an ad called Bole Jo Koel, where MS Dhoni is sitting on a cycle and singing a song. This year, just before the IPL, again we came up with new ad, and even on the MS Dhoni kit right now, you will see Emotorad logo, as he's the brand ambassador of the company. And this is what capital can do to you if you have raised it at the right time, right? And this entire journey of Emotorad from zero to around 250 crore rupees of revenue is a 3.5-year-old journey. And in 3.5-year-old, in 3.5-year-old journey, this is what the company has been able to achieve. Another company in my portfolio is a company called Work India. Work India is based in Bangalore, and what it does is essentially what Naukri does for IT jobs and accounts job. Work India does the same thing for delivery boys, telecallers, accounting executives. So what we call as the new collar jobs. So again, when I participated, the company was looking to raise around 1.5 crore rupees of seed funding. And post that, we at FundEnable have worked with the company on raising 6 rounds of funding. The last one was a $12 million round for the company per se. So this has been, my personal, I would say, strength, investing at an early stage, but also become the capital raising partner for our portfolio and our companies so that they can raise multiple rounds of funding going forward. And I'm not going to talk about all my companies per se. Over the years, we've done a lot of work in the early stage ecosystem. We are not structured as a fund. It's more through our own balance sheet. So not as a fund per se, but as a company investing in startups. Coming to today's topic, and it's one of the most important topics to understand. All of us know that India is the third largest startup ecosystem. We have around 150,000 registered startups, and together last year we raised around $12 billion of funding. So $12 billion went into Indian early stage businesses, Indian startups. I am not talking about the number that went in listed companies or large companies. All of this went into Indian early stage companies or companies like what you and I are working on. This $12 billion, if we break it up, it is almost 2,000 crore rupees on a weekly basis, or almost 250 crore rupees on a daily basis. So today we had an opportunity to raise 250 crore rupees. Tomorrow we will have a fresh pool of 250 crore rupees available. And that is the kind of capital that is available in the country, even in the midst of what we call as funding winter. So this number used to be somewhere around 25-30 billion dollars, even higher than that just before pandemic, during pandemic, right? And today it is at around $12 billion, and it is estimated that 2025 we'll raise around 14 to 15 billion dollars as Indian startups, all of us put together, right? So the point is that there is a lot of capital even today which is available. We need to just figure out what investors are really looking for out of multiple things. One of the things that they're really hell-bent on in today's market is what we call as unit economics. So let's just zoom out for a bit and understand how have investor expectations evolved over the years. Okay, so during somewhere around 2010, even if you had an idea, okay, a great idea and a good founding team, then just on the basis of the paper plan, just on the basis of a plan which you have put together, you were able to raise a round of capital. So I have a great idea, I have a great team, here is my pitch deck, and people were able to raise a round of capital. Somewhere around 2015, investors started asking, I want to see users. Okay, so even if you don't have paying customers, I am okay with it. I just want to see that people are actually using your product, even if it is for free, right? Somewhere around 2018 onwards, investors started asking, I don't care about users. I want you to show me customers, that are customers paying for the product, right? And then I'm going to invest in your company. Cut to 2020, 2022, investors started asking significant revenue. Even the angel platforms, angel networks started saying, you know what, we want to have a look at you when you have around 5 to 8 lakh rupees or 10 lakh rupees of monthly revenue. Even angel networks were writing emails to us saying that, hey, you are too early, come back to us 4 or 5 months down the line. Today in 2025, the situation is that significant revenue is not enough. We need to also showcase what is called as positive unit economics. So today the investor is going to not settle only on you making revenue, but they want to see whether you have positive unit economics in place. And what do we mean by positive unit economics? What do we mean by unit economics? We are going to come to that. But this is how the Indian startup investment ecosystem has actually evolved. Globally, what happened was, as the ecosystem grew, investors started investing earlier and earlier, which means that idea stage company can raise capital across the world. But in India, what has happened is, as the startup ecosystem has started maturing, investors are coming in later and later, which means even angels today are asking, boss, can you show me revenue? Can you show me unit economics, etc. Right? So it has become very important for us to understand this concept called unit economics. And Mark Anderson of A16Z, it is one of the largest and one of the most successful venture capital firms across the globe, right? And even the likes of him have started saying now that unit economics will ultimately determine the long-term success of your business. No amount of funding, right? You might raise like billions of dollars, but no amount of funding can save a company which has a fundamentally flawed unit economics, right? So it's not just here, but across the globe, huge focus on this concept of unit economics per se, right? Now, what is unit economics? For that, we need to first understand, what is a unit, right? So basically, how much value, what is the value that each unit or each item is generating? Or in simple terms, how much profit or loss each individual unit is generating. And by unit, I don't mean your business units, right? What is a unit? For a ride sharing company, each ride is a unit. For a D2C business, each item is a unit. For a food delivery company, each order will be considered as a unit. For a SaaS platform, each customer or each subscription will be considered as a unit. So the smallest element which is generating money for us is unit. And now we are going to double click on what is unit economics, right? Unit economics is basically how much value that each unit is generating. Basically, on every ride, am I making money or losing money? On every product that I'm selling, am I making money or losing money? On every delivery that I'm doing, am I making money or losing money? Right? So that is what is the core concept, right, of unit economics per se, right? Now let's understand how does unit economic work and what do we use or how do you calculate unit economic, right? So, and you guys can make a note of it or take screenshots while we speak. Uh, Basically, unit economics is what customer pays you minus all the direct costs that are attributed to that order, okay, or to that product or to that subscription, right? And the costs include the cost of the product if it is a physical product, fulfillment costs like delivery or servers, based on whether it is a tech product or a physical product. And third thing is the cost of acquiring a customer, and we are going to take a lot of examples and double click on it. But just understand this, that every unit that I'm selling, right, customer is paying me. Now, after the customer has paid me, what are the direct costs which can be attributed to that one unit, right? Whether it is a product cost, whether it is fulfillment cost, whether it is acquisition cost, right? And it's a sum of all of these three. Now, let's start with a very simple example to begin with. and then let's build it, basically as we actually go ahead, let's build it one by one, right? So I'm going to take a very simple example to make you understand the concept of unit economics, right? So let's say I have a startup, and what my startup does is I basically sell roasted coffee beans, right? I have mastered the art of, procuring coffee beans and roasting it really well. And this is the product that I'm actually selling out through the online channels. And I'm selling this packet for 550 rupees. Okay, I'm selling this packet for 550 rupees, but this packet is costing me 330 rupees, right? As a product, it is costing me 330 rupees. I may not, I may not uh, manufacture it myself. I am possibly outsourcing the manufacturing. So to me, the landed cost is at 330 rupees, right? So now the gross margin on this product is 550 minus 330, which is coming out to 220 rupees, or roughly 40% margin is there on this particular product, right? So what the founder is going and telling the investor that, you know what, I run a business which has 40% gross margin. But is this unit economics? No, this is not unit economics. Now, what is happening? This company is basically showing lot of Instagram ads, lot of Google ads to people, to customers, potential customers. And through these digital channels, the customer is basically buying the product, right? So basically, I'm showing a lot of Instagram and Google ads. And through those ads, I'm able to get customers per se, right? So let's say last month, I spent 2 lakh rupees on these digital channels or on all the marketing channels, right? And after spending 2 lakh rupees, I had 800 customers who bought my product, right? So 2 lakh rupees I spent, and 800 customers actually bought my product. So the cost of acquiring every customer, CAC, is the total marketing expense divided by the number of customers that have bought, right? Number of customers that have paid. So total marketing spends divided by the customers that have paid gives me a CAC of 250 rupees, right? So 250 rupees was the amount of money that I spent on getting every customer or onboarding each of these 800 customers that actually bought the product, right? Now, I'm going to load that onto the gross margin. So 550 rupees was the selling price, 330 rupees was the cost of the product. Gross margin on the product was 220 rupees, but the CAC on this product was 250 rupees. And then the cost of delivery, packaging, and payment gateway charges put together was 80 rupees. So now gross margin minus CAC minus delivery plus packaging plus gateway. See, all of these costs can be attributed to this one unit. I am not yet considering salaries, rent, electricity, none of that. It is only the cost which can be associated to every unit or per package of this sale, right? So what is happening on a gross margin of 220, I am actually spending 250 on CAC, and I'm also spending 80 rupees on delivery, packaging, gateway, etc. And therefore, my contribution margin, okay, or at the end, my CM is coming out to minus 110 rupees. So this company, every time it sells one packet of coffee bean, every time it is actually losing 100 rupees on from their pocket, right? From their pocket, 100 rupees is basically lost every time. So, to explain this, this is like sticking a 100 rupee note on every package and shipping it along with it, right? If I'm running a unit economics negative business, it is like on this packet, I'm sticking a 100 rupee note and I am shipping it with that 100 rupee. So that is the kind of money that these guys are losing at this point in time, right? At a unit economics level. So while this business might be really good, the coffee might be really good, the taste might be good, but at a unit economics level, this business is actually struggling to be positive per se, right? So what will happen? Okay, what will happen if you have a negative unit economics business, and let's say you raise a large round of funding. So if there is a negative unit economics business, and then you are spending or you are actually raising a large round of funding for scaling a negative unit economics business, what is going to happen is basically your losses are going to further widen, because the more the number of products that you sell, the higher is the loss in this case, because of the negative unit economics business per se, right? And therefore, it is of utmost importance today to check before investing. Investors check whether this business at a unit level is positive or is not making money or is losing money, right? Uh, so most of the times, CAC can be quite high and it cannot be recovered in one order. So why is also what is contributing to negative unit economics is also this CAC, right? And CAC will come into picture only on the first order, right? But now that the customer is aware of the brand, the customer has used the brand, the customer has tasted the product, what is going to happen? They are going to keep coming back, hopefully, again and again. And at that point in time, you don't have to spend CAC on them, and at that point in time, on the repeat purchases, possibly you are unit economics positive, right? Possibly you would be unit economics positive. And therefore, even if you have a negative unit economics business on the first order, it is important to actually understand and focus on value proposition per se. And this is a very, very critical concept, right? Why value proposition is important? Because you want your customers to keep coming back to you again and again and again. If there is a strong value proposition, after spending on CAC once, the customer want to come back again and again. If you spend on CAC, the customer bought the product, but they did not purchase more or the repeat orders did not kick in, then your value proposition is low, right? Is not strong. And that is the reason why you need to have a very, very solid value proposition. And how do we define whether the value proposition is strong or weak? There are two types of businesses. Okay. All the businesses in the world can be categorized in these two buckets. There is a vitamin business and there is a painkiller business. Now, what is a vitamin business? A vitamin business is a good to have business, which means, uh, you know, the customer, I know vitamin D is important for my bone health, but did I pop in a tablet of vitamin D today? Not really. Nothing is aching right now. I can still deliver a 1.5 hour session for all of you. So I did not pop in a tablet of vitamin D. But imagine if I break my bone, the first thing that I'm going to call for is a tablet of painkiller, and I'm going to call that person and say that, boss, get me this painkiller and get it to me right now. I need it right now. I don't care how much money someone is asking. I just need it right. Businesses can also be of these two categories. There can be a vitamin business and there can be a painkiller business. Vitamin business is a business where customers always basically call you and say that, oh, you know what, right now we are in the middle of festive season, or oh, you know what, we are nearing year end, so I don't want to make any spend right now. Whereas painkiller businesses are businesses which where they keep coming back to you. They are almost dependent on you. There is almost a sort of uh, dependency built, and they keep coming back to you again and again and again, right? Obviously, whether your business is vitamin or painkiller depends on the customer segment, right? So a particular business for a particular customer segment can be a painkiller, but the same business for a different customer segment can be a vitamin business. And therefore, for value proposition identification, you have to first identify which is that customer segment for whom your business is a painkiller business. And that is the reason why it is said that founders have to work on a niche offering, right? As startups, we have to be inch wide and mile deep, and not inch deep and mile wide, right? So you have to be extremely focused on a particular product, a particular customer segment, dig deeper and deeper to ensure that you have a very strong value proposition. And why is a strong value proposition required? For the customers to keep coming back to you again and again and again. right? So basically, you want the customers to come back to you again and again, and that is where understand this table really well, right? Let's say your unit economics is negative and your customers are not coming back to you again and again. You are not, the business is not great. Either the customers have not liked your product, or some other startup has showcased ads and this customer has moved to this another company person. Let's say your unit economics is negative, but your repeat ratio is high, then there is a very high chance that in repeat orders, you will start becoming positive in your unit economics. And imagine a business where your unit economics today is positive and your repeat ratio is also high. You are not just making money in your first order, but you're also making much more money in your second order because current unit economics on first order is positive and your repeat ratio is extremely high, right? So if I have to invest in a startup today, you know, the 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 ideal thing that we want is positive unit economics and high repeat ratio, right? Most of the D2C brands that raised a lot of capital immediately after the pandemic, uh, and they failed miserably. The reason why they failed miserably was they were not able to build a positive unit economics business per se, right? I'm going to take a quick pause here and see if there are any questions. There is a lot of activity on uh, the chat window. Let me see. Um, okay. Uh, Perfect. So at early stage, so Veda is asking that at early stage to attract customers, if we add reduced cost, discounts, or even for free at the first 3 months, will this come as a loss under unit economics? Yes. Discount will be considered under unit economics. And the reason why you are negative in your unit economics is because of this discount. And it is a perfectly okay strategy to begin with if you have a very strong repeat ratio, right? So typically, if you're buying for the first time, right? Even if you see right now, if you're buying something for the first time, you'll see that, hey, you know what? There are a lot of people who are giving you discounts, right? Offers. So it's all a part of their unit economics, but you have to consider it, right? Give us more examples of B2B. Yes, I'm going to have the next few examples are going to be about B2B, right? So we understand both B2C as well as B2B. There is a customer. So Vartika, unit economics can be calculated at two levels, one for new customers and one for existing customers. In your existing customers, in the unit economics calculation, CAC will not be a part, right? Because you have already acquired them, right? Um, Vishwa is asking, so CAC is only for customers who have come through that specific source. Insta ad, no. So what you can do is at the initial level, take your entire marketing spend, right? Don't worry whether it is digital or offline. Take your entire marketing spend and divide it by the number of customers that you have acquired and treat that as the CAC, right? Um, will Binu is asking a very important question. Will salespeople salary slash their commissions factor in CAC? In a way, yes, it will, right? But I'm going to talk about contribution CM1, CM2, CM3, and that is what I will I will basically explain in terms of when we talk about it, right? There is no negative in bracket symbol, just saying. Okay. Here I just mentioned it. I just said it. I think you're referring to this slide. Yeah, I'm just putting it out to showcase that, oh, you have to, look at this number per se differently. And that's where I've used a different coding to it. Um, Okay, how to calculate unit economics for repeat customers? Very simple. CAC will not be there, and that is what that is what you will have to basically calculate, right? How to apply it on a service-based business model? I'm going to B2B and service based, I'm going to talk about it, right? There is a very important question from Sheetal. Do we consider gross revenue, which includes GST, or net? Always remember, every calculation has to happen on net revenue, which is excluding GST. In fact, GST is not a part of your revenue at all. GST is not a P&L item. It is actually a balance sheet item. It is actually a liability that we have to pay, right? So never ever consider revenue numbers, even in your internal discussions when you are saying MIS also, that hey, what was your revenue today? What was your revenue this month? The the language should be always basically minus GST, right? Always remember this. That is what you will have to look at. Okay, last couple of questions. I have retail store of handicraft products. We have close to 700 SKUs. How do I measure the unit economics? So don't measure it on each SKU, okay? You have to measure it on an average order value, AOV, right? So you will not have unit economics at an SKU. Someone will come and buy maybe 3 or 4 products, right? So they will bill maybe 4,000 rupees. So consider what is your average order value over the past 3 4 months, and apply unit economics on that AOV rather than every SKU, right? That is what you will have to look at. Great. So I'm going to move on to the next topic, right? And I want to give you a very just for fun, I want to give you an example. And let's say we were looking at Zomato, right? So way before IPO, okay, way before IPO, Zomato was actually a negative unit economics business, right? So what was happening? The average commission that they were charging the restaurant was 43 rupees. The average fee that they were charging us as customers was 15 rupees. So their total revenue as such on an order was 43 plus 15. Now, at the cost level, they were giving 52 rupees to the rider who's delivering the product, and they were giving on an average 21 rupees of discount, right? So what was happening way before IPO, on every order delivered by Zomato, they were actually making, they were actually losing 40 rupees, 14 rupees or 15 rupees on every order. Imagine every time we order something, Zomato is losing 15 rupees, right? And this is how their unit economics was looking like, right? Before IPO, right? Obviously, they had to go for an IPO, they had to kind of justify the valuations, etc. So before IPO, what happened was the average commissions from the restaurants increased to 62.8 rupees. The delivery fees that we were paying as customers increased to 26.8 rupees. The rider fees, they actually reduced it to 44 rupees. They started paying less to the riders, and they also started giving us lesser and lesser discounts, right? So increasing the commissions and delivery fees on one side and reducing the rider fees and discounts on the other side, these initiatives were actually executed. And because of these initiatives, what happened was, from a negative 15 rupees, Zomato started making 30 rupees on every delivery, right? And this is possibly one of the easiest, unit economics example to understand, that from losing 15 rupees on every order, Zomato started making 30 rupees every time they were delivering an order, right? And this itself was a pre-IPO story, right? That boss, we are going to actually take this business and we are going to turn it to unit economics positive. Scale was not a challenge for Zomato, right? They were actually a scaled company. Unit economics was a challenge, and the entire pre-IPO, fundraise discussion was around, boss, by this time I want to become unit economics positive person, right? And that is the journey. So to investors, it is okay if you are unit economics negative today, right? We are startups. It's not that, oh, you know what, you have to be positive every time, right? But what is more important is understanding the fact that this is an important metric that I have to track, putting it out to the investors that today I'm at this level, but tomorrow I'm going to become unit economics positive. How? I'm going to cut spending on discounts. And how is it that it is going to work? How will customers react? What are my mitigation strategies? You have to answer that. I'm going to actually reduce my payout to delivery partners. how will you execute it? Will the delivery partners not kind of protest? Will the delivery partners not kind of complain? What is your strategy on that? I am going to increase the gross order value. So if I was only ordering, average order value was, let's say, 500 rupees, Zomato is specifically taking efforts to add to the order value, right? And finally, restaurants, they are going to ask for more commissions for restaurants, and why will it work, and how are they going to execute it, right? So the entire fundraise strategy would have been built on these 4 or 5 points, that this is how I'm going to cut discounts, this is how I'm going to reduce payouts, this is how I'm going to, these are the initiatives that I'm going to take to increase the gross order value, and this is what I'm going to do to increase the restaurant commissions. And I will become unit economics positive by this quarter. That thought process, that mindset is extremely critical when we are looking at this whole concept of unit economics per se, right? There are a couple of questions. Is there an expense to retain customers? Will it account to CAC? Yes. If there is an expense to basically retain customers, right? You are, let's say, giving some discounts, or you are basically doing some remarketing, right? You are actually doing a focused marketing exercise on each of your customers, right? Then whatever cost is related to again acquiring that, that has to be a part of not CAC as such, but maintenance charges, right? To get the customers to use the product, right? And data science, by the way, is playing a huge role, because with the help of data science, with the right tools, we can actually, like one of the companies that I'm closely associated with, they have created 110 personas of their existing customers, right? People who usually buy when they get a salary, people who come back after 6 to 7 months, people who are your power buyers, right? Power users are the ones who are actually coming back to you again and again, right? So such 110 personas are created, and 110 different offers, different communication, different kind of thought processes applied on each of these personas. Imagine, this is not even your new customers, this is your existing customers. Within existing customers, you have considered 100, you've made 110 buckets, and then you are actually targeting them in a very different way. And again, this is one area where AI and various tools can be actually can be leveraged, right? Vishwa is asking, so basically cutting payouts, increasing some charges, increasing overall revenue will give positive unit economics, not positive CAC. CAC is very different, right? Shalini is asking, does this apply to also B2B services industry? In a way, yes. And I'll actually give you a SaaS example and tell you how it works on SaaS per se, right? Um, how about a bandage business where customer needs only once or few times? Yeah, so there we don't have to focus on repeat as such, right? We will have to basically focus on only acquiring newer customers per se, right? Ajay is asking, and this is the last question I'm going to take before I move to the next topic. Typically, MRR and selling price difference is considered under CAC. No, Ajay. CAC is your cost of acquiring customer, right? MRP is what MRP minus, the selling price is your MRP. So there is no concept of MRP minus, unless it is distribution led, right? If it is distribution led, then your MRP and selling price will be different. And then that is your margin, right? That is not your CAC. How much money are you spending on acquiring customer is a CAC, right? Not basically the difference between your MRP and selling price. That is basically your margin, right? That's your, in a way, your gross margin per se, right? Uh, Great. So now we have to understand two more concepts. Okay, so and there is one more fine. So this is the second last concept that we will understand using example, and there is one more concept which is of CM1, CM2, CM3, which we will understand. But right now, let's understand the concept of what we call as LTV and obviously CAC. All of you have a lot of questions around CAC, And what is the connection between CAC and basically lifetime value of the customer? LTV is lifetime value of the customer, and CAC is cost of acquiring a customer, right? So let's understand what is this. Like I said, CAC is basically your marketing spends in a month divided by the customers that you have acquired in that month, right? Ideally, in CAC, we consider only digital spends. But during your initial days, include everything that you are spending under marketing. So branding, Google ads, Meta ads, if you're putting up a stall, anything and everything that you're doing under marketing, that divided by the number of customers that you have acquired, number of customers that you have acquired in a month, uh, that that division, right? Total marketing spend divided by the customers acquired is basically your CAC per se. Now, let's calculate lifetime value. Okay. And let's understand this, and then we'll apply it to your specific businesses. I'll also give you some examples. So let's say you are charging 3,000 rupees. Now, whether it is a product business or service business, right? Whether you are charging, let's say you are charging 3,000 rupees to the customer. And then all the direct costs which can be attributed to that sale, right? In case of product, we already saw an example, right? So the cost of the product, the CAC, the cost of the product, the shipping charges, delivery charges, etc. In case of a technology product, your AWS charges, your API charges, all of that, and I'll again give you examples. All of that are direct costs attributed to that product. Now, the margin on this product before CAC is coming out to 500 rupees. So 3,000 rupees minus 2,500, it is coming out to 500 rupees. And the CAC in this case is 2,000 rupees, right? So 2,000 rupees is the CAC, but the margin on the product before CAC is somewhere around 500 rupees per se, right? Now, assume that the customer buys the product 4 times in a year. And this is an assumption that you are going to make personally, either driven by your previous experience, or it's just an assumption that, hey, you know what, a product like mine will be used 4 times in a year or maybe every month, and the customer will continue with me for 3 years. After that, the need of the product will actually diminish. It will not be required, right? So what you have to assume, how many times in a year the customer is buying and how many years the customer will buy. So 4 times a year for the next 3 years. So what is happening? Total 12 transactions are happening. 3 years into 4 times. So total 12 transactions will happen. Now, margin before CAC on all these 12 transactions, right? So you know 500 rupees was the margin, right? So this 500 multiplied by 12 is 6,000 rupees, which is what I'm going to make ultimately as a margin, right? But first time when I acquire the customer, I have to spend 2,000 rupees on CAC. So now I subtract, right, this 2,000 from CAC, and what I get is 4,000 rupees, right? So what is happening? Total 12 transactions I'm assuming the customer will do. Each transaction is giving me 500 rupees of margin before CAC. So my total margin is coming out to 6,000 rupees. But to acquire the customer first time, I have to spend 2,000 rupees of CAC. So now LTV, lifetime value, is basically margin before CAC on 12 transactions, 6,000, minus CAC is 2,000. That is coming out to essentially 4,000 rupees. And my LTV to CAC ratio is 3x. Okay. So LTV is 6,000, CAC is 2,000. So LTV to CAC ratio is 3x. And I've made 4,000 rupees on my initial investment of basically 2,000 rupees, right? The margin 6,000 minus 2,000. And how much did I spend? 2,000 rupees on CAC, right? So what this LTV to CAC ratio is very, very important for us to understand. So typically, 3 to 5 times of LTV to CAC ratio is a very healthy ratio. So if you are in 3 to 5 times, your business is going to make money. If you are above 5x, then you are really killing it. You've really cracked how to actually run a business, which includes repeat, which includes controlling a lot of direct costs, etc. Right? So 3 to 5x is considered healthy. Beyond 5x is when you have to bring it out and talk to the investors, because investors will be like, boss, how do you have 5x LTV to CAC? It's an amazing ratio, right? Now, not all users will stay on your platform for 3 years. Okay, it's just an assumption, right? Not all users are going to essentially be on your platform for a period of 3 years per se. So in this case, you need to consider, and it will not happen in the initial days, but in your later days, as you grow, you will also have to consider one more factor called the churn rate, right? What is a churn rate? How many times the customer, on an average, how many times the customers are using and leaving the product, right? They are not coming back. So that average churn rate is very, very important, because if there is a high churn rate, right? If the churn rate is, is high, then your LTV is going to be low, right? So if you suddenly realize that, oh, you know what, my customers have started churning, or the churn rate has suddenly increased, immediately what is going to happen is your LTV will fall. You will have to figure out why is the churn rate high. You will have to start taking steps to ensure that your churn rate comes back on, or your churn rate reduces, and your LTV is actually increasing person, right? So in startups, always remember, the founder is not taking all the decisions. The data is actually taking most of the decisions, right? So as a founder, my job is to actually look at a dashboard of all the possible metrics that give me a sense of business, right? So simple things, right? Unit economics is negative, but even repeat ratio is negative. I need to really think whether my product is working or not. I had a great LTV, but suddenly the churn rate has increased. Why has it increased? What happened suddenly that customers have started, leaving the platform? Is it because there is another startup that had come up, which is offering the product at a much cheaper cost, or the product quality has deteriorated? What is the reason? So we have to plug that. So every time we actually, we actually look at the data is giving us a lot of insights, and according to those insights, according to those, kind of matrix, we have to take the decisions. Fair? That's what important for us to understand. Also, you have to consider what is called as AOV, or average order value, right? So average order value is very, very critical to unit economics. Why is it critical? Uh, because average order, so in basket purchases, AOV is playing an important role. What do I mean by basket purchases? Like we got an example, right? If a person walks into a store, uh, they are not going to buy one SKU and leave. It's going to be a basket, and that basket is going to be the average order value, right? So that AOV calculation is very, very important. Higher the AOV, better the unit economics. In India, if you are doing a business where your average order value is less than 300 rupees, it is very, very difficult to actually, sustain that kind of a business. Therefore, a lot of these grocery, apps, and all of these Zeptos of the world, the average order value is small. And now, if you see on the app, all of them try to push in more products into the basket. Do you want to buy this? Last time you had ordered this. Do you want to buy this? With this product will go really well. Do you want to add this? So, what are they trying to do? They are trying to kind of increase the average order value. And by increasing the average order value, they are essentially trying to better the unit economics person. So, I'm going to take a quick pause here and see if there are any questions related to this particular concept, right? Um, so Vartika is asking, what should be the frequency to do unit economics and unit economics analysis? So Vartika, most of these can be seen uh, bare minimum at a monthly basis, but a lot of times it can be also done on a daily basis, right? In extreme cases, as you scale. But on a monthly basis, you should definitely have a look at the unit economics for sure, right? Shri LP is asking, so to make the AOV better, does this also mean we should have products from all price ranges? Yeah, I mean, you can have an entry level product to acquire the customer, but on the repeat purchases, you can sell a higher value product, right? You can actually sell a larger value product going forward, right? So not necessarily the AOV to increase the AOV. Not necessarily you will have to basically have products from all price ranges. It is just that uh, at the end of the day, you have to ensure that the billing per customer is higher, right, and not lower, right? Uh, how do you do this in service business? Let me talk to you about that, right? Um, so now we have to understand one more concept, and that concept is again extremely critical, right? And that concept is of CM1, or contribution margin 1, contribution margin 2, and contribution margin 3, what we call as CM1, CM2, CM3. So investors are going to ask you, show me your CM1, CM2, CM3. How is your CM profile looking like? What does it mean? They are basically asking for your contribution margin tables, right? So in this case, let us look at a SaaS product, okay, a SaaS business, right? In a SaaS business or a service business, what happens is you have a subscription cost, and then you have some direct costs related to servicing that customer, or we can also call it as COGS. And subscription cost minus COGS will actually give you contribution margin 1. So let me explain how will it work. Let's say I am charging a subscription of $100, right? And this is the CM1 calculation. Let's say at the CM1 level, I am charging basically $100. And now my hosting charges related to this, server charges related to this $100 is $20. So what I'm doing, I'm calculating the total hosting charges divided by the number of subscriptions that I have, and the number is coming out to 20. Now API charges is coming out to $5. So again, I'm dividing the total number of subscribers by the total, essentially the total cost on APIs divided by the total number of subscribers that I have, right? Let's say I have a support team to answer some of the questions, or to kind of, give them support, right? So what am I doing? The total cost of my, support team divided by the total subscribers will give me what am I attributing it to per subscriber basis, right? So basically, my direct costs associated with this subscription, whether it is servers, APIs, a team which is servicing this subscription, okay, not the one which is developing the product, only the team that is servicing or which is playing a part in operations of this subscription is basically considered. And so all of this is coming out to 20 plus 5 plus 5, which is coming out to 30, right? So my contribution margin 1, which is basically my cost or whatever my sales price, subscription price, minus the direct costs associated with this subscription, is basically my CM1. And that is coming out to 70 rupees or $70, or it is 70%. So my CM1 is 70%, right? Now to go from CM1 to CM2, I basically load on the CAC, right? So CM1, so this margin 70 rupees minus CAC is basically CM, right? So $70. So again, in this case, I spent on Google Ads a lot, or I have a sales team and their commissions are, kind of I'm paying those commissions. Or I have other marketing expense, like I'm putting up a stall at a large exhibition, right? So whatever, how did we calculate CAC? Whatever cost I incurred in this month in terms of marketing, divided by the total number of customers that I acquired in this month, right? And that is giving me CAC. Always remember, the more you focus on organic channels and referrals, the better or the lower is your CAC, right? So if your product has a very high word of mouth, or has a very high referral element, then the CAC is going to be lower, right? Because the cost is going to get divided over large number of users, and those users or customers have not come by seeing your ads only, right? And therefore your CAC is going to be lower. So $70 minus $20 of CAC is giving me $50 of contribution margin 2, or CM2, right? So my CM2 is basically now coming at 50%, right? So CM1 was my unit cost, my subscription, minus all the direct costs attributed to that one unit, and that came to my CM1. CM2 is CM1 minus CAC is my CM2, right? And what is my CM3? Let's try and understand my CM3. CM3 is CM2 minus the general and admin cost per customer. So now take all your other expenses, your salaries that you're paying to your team, right? Your rent, your legal costs, your other costs, anything and everything which is left. Divide that cost, that total cost, by the total number of customers, right? So GNA per customer, CM2 minus GNA per customer will give you CM3. So total salaries plus rent plus legal plus other costs divided by the total number of subscriptions will give me GNA per customer. Now, how to reduce GNA per customer? Basically focusing on automation, and that automation, use of technology can significantly reduce the kind of office space you need, the number of people that you need, right? So the more you optimize, the more you actually automate, the more you leverage technology, the lower is your GNA per customer per se, right? So in this case, what is happening is my GNA per customer is $100, right? So my $50 minus GNA per customer is coming out to $100, and my CM3 is negative 50, right? So CM1 is positive, CM2 is positive, but CM3 is negative, and this is perfectly okay when you are looking to raise a round of capital, because your salaries, your rental, etc., is right now not enough to cover uh, your all your expenses. But at least at the CM1 CM2 level, you are positive and you are making money, right? So ultimate goal would be to become CM3 positive, and that is where you will be at an overall company level. You will also be what we call as EBITDA positive per se at a company level, right? But that CM1 CM2 CM3 journey, showcasing it today, is very important. Even if you build a small section in your deck that talks about unit economics, current unit economics, how is it going to kind of change? How is it going to kind of, look at over the years, what initiatives are you going to take to make it better, right? So let's say I'm CM1 positive, CM2 positive, but I'm CM3 negative. I will actually build a slide in the appendix section on this. Why am I CM3 negative? What are the initiatives that I'll take to make myself CM3 positive, right? By when will it happen? So all of these things will play a very critical role in actually getting your business unit economics positive per se. I'm going to take a quick pause here and see if you have any questions. Okay. Would it make sense to go with negative unit economics till early adoption is stabilized? So Ajit, yes, in a way, like I said, negative unit economics is not a bad thing. it is a bad thing if you are not able to track the signals. Okay. Like I said, first time customers, negative unit economics, there is still a hope that, you know what, my customers are going to come back and then I will make money. But when they come back, are you making money and are they even coming back? Right? There is no point in running a negative unit economics business. Our entire endeavor has to be from day one, can I build a positive unit economics business, at least at the CM1 level to begin with, then at a CM2 level to begin with, right? That is what you will have to look at. Rashi is asking rent of the store, okay, or revenue share to be considered in CM1. So if it is rent of the store, I would consider it in CM1. But if it is rent of the office, right, then I'll consider it in CM3 in GNA. Right. So take that call yourself. What is directly attributing to the sale and what is indirectly attributing to the sale per se. Uh, Vartika is asking, please share the general unit economics going in manufacturing sector. Else, what is the ideal unit economics in the market? See, for every sector, it is very different, right? For services businesses, for SaaS businesses, expectations is that you have to have a very high unit economics, upwards of 70% margins, because there is no cost of goods sold. There is no physical product being used. But in product business, D2C kind of businesses, typically you have a 60% gross margin. And then, at a CM2 level, you will be at a 30-35%. And then CM3 level will evolve going forward, right? So for different businesses, different unit economics are considered, right? Um how much runway cost? Okay, sorry, any unit economics example which covers CM1, CM2, CM3? Ajay, you tell me now, right? You kind of show me unit economics example, think through it and put it on the chat window, right? For D2C, how will, because we already considered one, thing, right? Where the first revenue or unit minus the COGS will be your CM1, minus the CAC will be your CM2, and minus all your GNA expenses which are per unit allocated will be your CM2. So same logic, apply it on D2C and you will get CM1, CM2, CM, right? Um, Nilima is asking, in e-commerce financial reporting, cost of return goods can be indeed be significant pain point. This cost has to be accounted in unit economics as well, right? Because cost of returns can be put it under the direct cost, right? Whatever CM1 may consider kar lo, returns, right? Basically average it out, right? That this was the cost of returns on the total number of units that I sold. So I can attribute it to per unit basis, right? It's very important question and it has to be considered at the unit level. At the initial level, it can be a problem. But if I'm looking at your business and wanting to invest in your company, I should see a trend line that your returns are going down, down, down as we actually scale the business. Your returns are also falling, right? Shri, I think I've answered the question that you are asking. Uh, when you have venture which has two verticals, product based and subscription based, how do you calculate? You calculate it differently for both, right? You have a different structure on product and you have a different structure on subscription. Or if product and subscription go hand in hand, calculate on a basket that every time one buys a subscription, they buy two products, right? So you consider it on AOV, right? Average order value, which can be a mix of subscriptions and product, right? So wherever you have a basket, right, where I'm selling one or more products, or I'm selling subscription and products, or I'm selling one or more services bundled together, treat it at an average order value level or an AOV level per se, right? Uh, Great. So, trying to make your business unit economics positive is one of the most challenging problems that you're going to face. But it is one of the most important challenges to overcome, because that determines whether the business is going to survive for long or not. And this is why I showed the evolution of the investors, right? People pumped in millions of dollars in companies which were not unit economics positive, but there was just a hope that boss ये कर लेंगे तो ये unit economics positive बन जाएगा, it will become, but that it will become never happened. And because of that, billions of dollars, millions of dollars were actually lost, right? Look at the story of Uber. You will see how it is a great example of making it unit economics positive. Look at the WeWork story, and you will understand what happens if unit economics is not considered and if unit economics is negative, right? So the more and more people have started looking at these different metrics. So running a startup essentially means looking at 10 or 12 different metrics which are relevant for our business and let data take the call. As founders, we are very biased about the product. I have met founders who are so biased about their product that, boss, my product is very good, my product is 10 times better than competition, my product has so many features. But ultimately, then if it is all that good, why is at a margin level it is not making money? Do you have an answer to that? And then the founders don't have an answer to it, right? Yeah. And so you have to be extremely dispassionate while taking decisions, because data has to take decisions. For how long will you be running a negative unit economics business? Do you see a, do you see it changing? If yes, when? And what are some of the milestones that you have actually put out? Otherwise, you just move on to the next thing per se, right? So that's the overall structure or reason of looking at unit economics, right? Shri LP is asking, how do you break even? How do you do break even analysis when you have, see, break even analysis is done at a company level, right? So the total number of products that you have sold, the total. So in a way, if you are CM3 positive, okay, you can say that you have broken even, right? So if you are CM3 positive, which means your per product, per unit is able to take care of the direct costs, is able to take care of the marketing cost, is able to take care of your general and admin or expenses, right? Overheads. So which means on an every product basis, you have already broken it, right? Now, break even is also taught in terms of the amount of money that I've put in and when will I recover. That in startups will take some bit of time, right? At an overall level per se, right? So that is what we have to look at. Any questions, any thoughts? Anyone wants to kind of quickly, take us through what is their idea of unit economics in terms of, their specific businesses? Happy to understand that. Happy to kind of, give you my comments on that per se. Uh, Very, very happy to do that. In the meanwhile, what I'm going to do is I'm going to share my LinkedIn profile with all of you on the chat window. I keep posting a lot of stuff around how startups should look at data, concepts like unit economics, which are the right sources to also learn about these concepts, right? Because, see, as founders, we hit a glass ceiling very easy, right? Very easily, we are able to hit a glass ceiling because there is no one to discuss. We are working on our own terms, in our own with our own capabilities, right? So it becomes very important for us to actually continuously keep our keep us updated with newer and newer concepts that come up, right? Concepts like MAU, DAU, unit economics, right? CAC, and startup world is known to coin more and more such concepts every now and then, right? They will come up with more and more concepts and newer concepts, right? For example, there is one metric, I don't know if you're aware of, but one metric which became extremely famous is a metric called NPS, Net Promoter Score. NPS was never known before 2007, 2008. No one knew about what NPS is. But suddenly people started talking about NPS and showcasing it in your pitch deck that, hey, my NPS is this, right? So, what is NPS? How to calculate NPS? How to apply it to my business? What is unit economics? How to apply it to my business? All of these things are very, very important. And therefore, what I'm going to do is, and I obviously I've shared my LinkedIn profile. I keep giving you a lot of lot of stuff on LinkedIn as well. But what I'm also giving to all of you on a chat window is a list of books that all of you should read to kind of get every great knowledge about uh, basically startups, right? And the lingo of startups. And if you don't have time to read these books, go to my LinkedIn profile. You will find 2-page, 3-page summary of all of these books. So if you don't have time to read the book, go to my LinkedIn, and I have my written notes. I have uploaded it on my LinkedIn as a post, and you can read those in like one weekend. You can read all of these books just by looking at my LinkedIn post per se of the past. Let's say if you don't even want to do that, then what I would suggest as next step is I'm going to give you a list of movies and list of kind of um, web series to watch. Okay, so whatever I'm sending it to host and panelist. I'm not seeing an option to send it to all the webinar participants. So host, can you just copy paste all my messages? Yeah, Samita, thank you. So Samita has copy pasted all the three things: books, the movies that you can watch, and also my LinkedIn profile. So that is what you can actually look at, and you will be able to really gain a lot by getting it, because this is what I have faced as a founder, that because I'm alone. I'm not, when you're working at a large company, you have your team members, you have your boss to discuss with. Suddenly when you start working on your own as a startup, you don't have anyone to discuss concepts. Your learning kind of caps, right? So the constant endeavor has to be to keep on breaking that glass ceiling. Otherwise we'll be operating at a certain level, and then we will not be able to go to the next level per se, right? um, Great. So I think that's it from my side on today's topic of unit economics per se. We also have one more session coming up in the next week. I keep taking a lot of sessions at NSR Cell, a lot of sessions anyways on my LinkedIn. You will be able to see, and you will be able to kind of attend. So happy to assist all of you, whatever I know, transfer that knowledge to all of you. And all the best, and stay in touch. And once again, thank you to the NSR Cell team for giving me this opportunity to talk to all of you. And all of you were amazing. You were so engaged. You were asking a lot of questions. Thank you so much. Looking forward to meeting all of you someday. Thanks a lot. Over to you, NSR Cell team.
Yes. Thank you so much, Vikrant, for taking the time out to do this
Thanks,
session.
Amita. Thank you.
You're so right. We saw I think one of the highest engagements, and this has been a wonderful month. All the founders who've been joining us have been so engaging. And I think thank you for mentioning that you're doing the session this Friday. So to all the founders who joined today, we'll be sending you the details of the session on Friday. So that's, if that's of interest, you can join that as well. And you can hear from Vikrant again. So yes, before we end the session, just again, thank you so much all for joining in. And again, thank you, Vikrant. Awesome, everybody. Thank you. Bye-bye.